Ladies and gentlemen, financial crises rarely announce themselves with sirens. They appear first as anomalies, unexpected price movements, unusual volume, or sudden shifts in confidence. What we are witnessing in the silver market today is not merely a price spike or a speculative episode. It is a stress signal, a signal that invites serious questions about transparency, market structure, and trust in the systems that underpin global commodity pricing. When silver surged toward the $66.50 level, it did more than move charts. It challenged assumptions about control, liquidity, and the mechanisms designed to stabilize markets during moments of extreme pressure. For decades, the COMEX has functioned as the reference point for global silver pricing. Its role is not only to facilitate trading, but to project confidence that supply, settlement, and pricing mechanisms can withstand volatility. When prices accelerate rapidly, exchanges rely on safeguards, margin adjustments, trading halts, and liquidity controls. These are often described as kill switches, not because they end markets, but because they are meant to prevent disorder. The question raised by recent price action is not whether such mechanisms exist, but whether they remain effective under sustained stress. The rapid move in silver prices toward the $66.50 level should be understood as a signal of structural stress rather than a simple episode of speculative excess. Markets driven purely by speculation tend to move erratically and reverse quickly once momentum fades. What distinguishes this moment is the persistence and intensity of pressure across multiple layers of the market at the same time. Price action is being reinforced by changes in positioning, liquidity behavior, and sentiment, suggesting that deeper forces are at work beneath the surface. At its core, the silver market sits at the intersection of finance and physical reality. Futures, contracts, options, and other paper instruments are designed to provide liquidity and efficient price discovery. Under stable conditions, these tools function smoothly because confidence exists that paper claims can ultimately be reconciled with physical supply. When prices accelerate sharply and remain elevated, that confidence begins to erode. Participants start to question whether market signals are being driven solely by trading behavior or by underlying constraints that are no longer easily absorbed. The move towards $66.50 intensified this tension. Such price levels concentrate leverage, margin exposure, and institutional risk, forcing rapid adjustments across the system. Short positions face rising collateral demands, liquidity providers become more selective, and volatility feeds into risk models that amplify defensive behavior. These reactions are not emotional, they are mechanical. They are embedded in the architecture of modern markets, where stress in one segment quickly propagates through others. What makes this episode particularly significant is that it aligns with broader structural trends rather than isolated catalysts. Industrial demand for silver continues to rise due to its role in energy systems, electronics, and advanced manufacturing. At the same time, supply growth remains constrained by long development timelines, regulatory hurdles, and geographic concentration. Financial markets are attempting to price this reality in real time, often faster than the physical system can adjust. The result is sustained tension rather than a brief spike. Speculation still plays a role, but it is not acting alone. Traders respond to signals, and those signals increasingly reflect uncertainty about inventories, delivery capacity, and the reliability of settlement mechanisms under stress. As confidence shifts, behavior changes. Market participants reduce exposure to abstractions and seek reassurance in tangible assets. This transition does not require proof of systemic failure. It is driven by perception, and perception itself becomes a market force. The language of speculation often minimizes these dynamics by framing price moves as irrational or detached from fundamentals. That framing obscures the fact that modern markets are highly sensitive to structural imbalances, especially when leverage and physical constraints coexist. When price discovery mechanisms begin to strain, volatility becomes a symptom rather than the cause. The market is reacting to limits, not inventing them. From a political and policy perspective, this distinction matters. A speculative bubble can be addressed through regulatory tightening or market correction. Structural stress demands a different response, one that examines transparency, resilience, and alignment between financial instruments and physical supply. Ignoring these signals risks allowing pressure to build unnoticed until confidence breaks more abruptly. Silver's surge towards $66.50 is therefore less about excitement and more about exposure. It exposes how tightly coupled financial markets are to material realities and how quickly stability depends on trust in systems that were designed for efficiency, not prolonged strain. In this context, price becomes a messenger, carrying information about the health of the underlying structure. Dismissing that message as mere speculation overlooks the deeper warning embedded within it. Market safeguards, such as margin requirements, position limits, and temporary trading halts, are designed to function as shock absorbers during moments of sudden volatility. Under normal conditions, these tools are effective because volatility is typically brief and localized. What recent silver price movements reveal, however, is how these mechanisms become increasingly strained when volatility is sustained rather than episodic. When price pressure persists over time, safeguards no longer operate as stabilizers. Instead, they become active participants in amplifying stress. As prices rise rapidly and remain, elevated margin requirements adjust upward, forcing participants to commit additional capital simply to maintain existing positions. This process can trigger cascading effects. Liquidity tightens as some participants exit not because their outlook has changed, but because their balance sheets cannot absorb repeated margin calls. Market depth thins, spreads widen, and price discovery becomes more sensitive to relatively small shifts in order flow. These are signs of systemic tension, not disorderly behavior. Trading limits and halts, often framed as emergency controls, face similar constraints. They are calibrated to pause panic, not to manage prolonged structural imbalance. When underlying pressures remain unresolved, activity resumes with the same unresolved risks still present. Participants become cautious, hedging behavior changes, and confidence in the market's ability to self-correct weakens. This dynamic raises important policy questions. Safeguards built for speed may be ill-suited for endurance. When volatility reflects deeper supply, demand, or confidence issues, mechanical controls can slow motion but cannot restore equilibrium. The market continues forward, carrying the accumulated strain beneath the surface where it becomes harder to observe and more difficult to address. As concerns grow about the alignment between paper markets and physical silver availability, investor behavior begins to shift in subtle but powerful ways. Futures contracts and other derivatives are built on the assumption that they accurately reflect underlying supply conditions, even when physical delivery is rare. When that assumption comes into question, confidence weakens and market participants reassess how much trust they place in abstraction. This reassessment does not require proof of shortage. It is driven by uncertainty, and uncertainty alone is enough to alter behavior. As doubts emerge, demand migrates toward instruments perceived as more directly connected to physical reality. Some participants reduce leveraged exposure, others shorten time horizons, and some seek alternatives that offer greater transparency or control. These adjustments tighten liquidity and increase sensitivity to price movements. The market becomes less forgiving, reacting more sharply to new information or perceived risk. What might otherwise be absorbed smoothly instead produces outsized effects. This shift also changes the narrative around price discovery. Prices are no longer viewed simply as outcomes of trading activity, but as indicators of stress within the system. When physical availability is perceived as constrained, each price move carries added significance, reinforcing caution and accelerating defensive positioning. The feedback loop strengthens, even in the absence of confirmed supply disruptions. The gap between perception and verification becomes increasingly important. Markets operate on expectations as much as data, and once confidence in alignment erodes, restoring it becomes difficult. This dynamic highlights how belief itself functions as a form of leverage, capable of reshaping behavior across the entire market structure long before any material imbalance is formally acknowledged. Confidence is the invisible infrastructure that holds commodity markets together, and in periods of stress, it often matters more than inventory data or official reports. While physical availability sets long-term boundaries, short and medium-term stability depends on whether market participants believe the system will function as expected under pressure. When confidence is strong, markets can absorb shocks, reconcile discrepancies, and maintain orderly price discovery even during volatility. When confidence weakens, those same mechanisms begin to fracture, regardless of whether physical stocks are technically sufficient. In the silver market, confidence is anchored to trust in settlement, delivery optionality, and transparency around reserves. If participants begin to doubt that contracts can be honored smoothly during extreme conditions, behavior changes rapidly. Liquidity providers reduce exposure, hedgers become more defensive, and risk premiums rise. These reactions are not speculative impulses, they are rational responses to uncertainty about system reliability. Once confidence erodes, volatility feeds on itself. Each price movement is interpreted not just as a market signal, but as evidence of deeper instability. Participants respond preemptively, reinforcing the very dynamics they fear. Official reassurances or inventory disclosures often fail to restore calm because trust once questioned cannot be rebuilt instantly through data alone. This dynamic illustrates why market stability cannot be managed solely through numerical thresholds or regulatory controls. Confidence is qualitative, shaped by experience, transparency, and credibility over time. When that foundation weakens, markets become fragile, and even well-designed structures struggle to function as intended. In such environments, restoring stability requires more than intervention. It requires rebuilding belief in the system itself. Key price thresholds in commodity markets carry significance far beyond their numerical value, acting as focal points where financial exposure, institutional risk, and political attention converge. In the silver market, levels such as $66.50 function as psychological and mechanical pressure zones. At these points, leverage intensifies, margin requirements escalate, and risk models across banks, funds, and exchanges are recalibrated simultaneously. What might appear externally as a single price movement internally triggers a chain of defensive responses embedded in the financial system. As prices approach such thresholds, positions accumulated under lower volatility assumptions are suddenly reassessed. Institutions managing large exposures must respond not only to market direction, but to regulatory capital requirements, internal risk limits, and counterparty expectations. This convergence amplifies sensitivity. Small price changes can produce outsized reactions as automated systems and human decision-makers respond to the same signals at the same time. The result is acceleration, not because of panic, but because of structural alignment in risk management behavior. These moments inevitably attract political scrutiny. Sharp moves in strategic materials raise questions about market oversight, price discovery, and the resilience of financial infrastructure. Policymakers become alert to potential spillovers into inflation, industrial costs, and public confidence. Price thresholds thus become political events, not merely financial ones, prompting debate over regulation, transparency, and systemic stability. In this way, the silver market illustrates how price is no longer just an economic metric. At critical levels, it becomes a signal interpreted by institutions, regulators, and governments alike, transforming financial stress into a broader issue of governance and public trust. Strain in the silver market carries implications that extend well beyond trading desks and commodity exchanges, reaching into the core of economic policy and strategic planning. Silver is not an abstract financial asset. It is a critical input for energy systems, advanced manufacturing, medical technology, and national infrastructure. When price discovery in such a material appears unstable or contested, it raises concerns about the reliability of the mechanisms that govern access to resources essential for economic continuity. This transforms what might otherwise be viewed as market volatility into a matter of public interest and policy relevance. Governments rely on predictable commodity markets to support industrial planning, inflation management, and long-term investment strategies. When confidence in those markets weakens, uncertainty spreads across multiple policy domains. Rising and volatile silver. Prices can affect the cost structure of clean energy projects, technology manufacturing, and defense-related industries simultaneously. Policymakers are then forced to navigate competing priorities, balancing market stability against regulatory intervention while attempting to preserve credibility in institutions designed to manage systemic risk. The political dimension becomes more pronounced as public narratives form around fairness, transparency, and control. Questions arise about whether existing frameworks adequately reflect physical realities, whether oversight is sufficient, and whether concentrated influence within commodity markets creates vulnerabilities. These debates are not limited to financial regulation. They intersect with industrial policy, resource security, and broader economic governance. Silver's role as a strategic material amplifies these concerns because disruptions resonate across sectors that underpin national competitiveness. At the international level, market strain feeds into diplomatic and trade considerations. Countries dependent on stable access to strategic materials reassess their exposure to external shocks and reconsider diversification strategies. This can influence alliances, trade negotiations, and investment flows, reshaping economic relationships over time. What begins as tension within a single market thus contributes to a wider reevaluation of resilience and sovereignty. In this context, silver market stress functions as an early indicator of broader systemic challenges. It highlights the need for policy frameworks that integrate financial stability with material security, recognizing that economic resilience increasingly depends on the alignment between markets, physical supply, and institutional trust. The surge in silver prices is not a verdict, it is a question about whether existing market structures are prepared for a world of tightening resources, rising demand, and declining trust in abstraction. The so-called vault leak is less about metal and more about confidence. Confidence that the systems governing global markets remain aligned with reality. History shows that when confidence fractures, reform follows, either by choice or by necessity. The real issue before us is not whether the system blinked, but whether it adapts before the next stress test arrives. Thank you.